In 2008, the global economy was brought to its knees by what Wall Street swore were the safest investments money could buy. This wasn't a fluke or some act of God. It was a man-made catastrophe, built on a mountain of greed, mind-numbing complexity, and a single absurd question. How did they convince the world that trillions of dollars in sketchy loans were AAA-rated gold? This is the story of modern financial alchemy, a scam that turned bad debt into billions and then vaporized the wealth of millions. It's the story of a ticking time bomb, assembled piece by piece in plain sight, with a promise that it was too safe to ever explode. That bank would then bundle thousands of these mortgages together and sell them to investors all over the globe. Interest rates were at historic lows. Following the dot-com bust and 9/11, the U.S. Federal Reserve made money cheap to get people spending. And boy, did it work. Suddenly, the American dream of owning a home felt closer than ever, creating a massive appetite for mortgages. Wall Street, never one to let a gold rush pass it by, rolled out a new business model: originate to distribute. The idea was simple, but revolutionary. Traditionally, if a bank gave you a mortgage, they held on to it. They cared if you paid it back, because if you didn't, it was their loss. All at once, the original lender had no skin in the game. Their incentive wasn't to make sure you were a good credit risk. It was to sign up as many people as they could, as fast as they could, collect the fees, and pass the hot potato down the line. This lit the fuse on an explosion in subprime lending. Loans made to borrowers with bad credit, shaky income, or no down payment. Lenders got creative, offering NINJA loans. No income, no job, no assets. Predatory lending became the norm. As the Financial Crisis Inquiry Commission later put it, collapsing mortgage lending standards were a key cause of the crisis. The supply of good borrowers was running out, but the machine had to be fed. So standards hit rock bottom to keep the raw material, the debt, flowing. The theory was that the top glass, the senior tranche, was so protected by the layers below it that it was practically impossible for it to ever run dry. The answer lies in a three-letter acronym: CDO, which stands for Collateralized Debt Obligation. First, investment banks bundled thousands of individual mortgages into something called a mortgage-backed security, or MBS. Just think of it as a giant basket of mortgages. Whoever owns the MBS gets the cash from everyone's monthly payments. That part wasn't new. But the next step was pure Wall Street wizardry. The banks took slices from hundreds of different MBS, many stuffed with those risky subprime loans, and bundled them together into a new, wildly complex product, the CDO. Picture a champagne tower. The mortgage payments are the champagne, poured into the top glass. This top glass is the safest part of the CDO, the senior tranche. It gets paid first. Once it's full, the champagne spills over into the glasses below, the mezzanine tranches, which are a bit riskier. The ones who gave those top CDO tranches the coveted AAA rating, the highest rating possible, the same as U.S. government bonds. It was financial witchcraft. Pension funds and city governments, often required by law to hold ultra-safe assets, were hungry for them. And Wall Street had just created a seemingly endless supply, generating billions in fees. Between 2003 and 2007, nearly $700 billion of these complex instruments were issued. This whole scheme needed one more thing to work: a legitimate-looking stamp of approval. That stamp came from the credit rating agencies, Standard & Poor's, Moody's, and Fitch. These were supposed to be the independent referees of the financial world. The Financial Crisis Inquiry Commission didn't mince words, calling the rating agencies essential cogs in the wheel of financial destruction. Their complex mathematical models were built on one critical and ultimately catastrophic assumption: that housing prices in different parts of the U.S. were uncorrelated. They figured a housing bust in Florida wouldn't affect the market in California. So even if some loans went bad, most would be fine, and the cash would keep flowing to the top tranches. But here's where the story gets even weirder. Post-crisis research from the University of Chicago found that, contrary to the popular narrative, many of those AAA-rated securities actually performed surprisingly well. Cumulative losses on all AAA-rated residential mortgage-backed securities through 2013 were only about 2.3%. The AAA-rated subprime segment did even better, with just 0.42% in losses. This research suggests the agency's relative rankings, the idea that AAA was safer than the riskier tranches, were often correct. The music was still playing, and no one wanted to leave the dance floor. But the first tremors were starting. A bizarre trend emerged. People were defaulting on their brand new mortgages within months, something that was almost unheard of. The foundation of sand was starting to shift. Behind the scenes, the game got even crazier. Wall Street started creating synthetic CDOs. These didn't even hold real mortgage securities. Instead, they were built from credit default swaps, basically insurance policies or side bets on whether other CDOs would fail. This let bankers create and sell securities that were just bets on top of other bets, multiplying the risk exponentially. Panic. But understanding how it happened is the first step toward demanding accountability and preventing it from happening again. If you find this breakdown valuable and want to understand the forces that shape our world, make sure to subscribe and hit the notification bell. In 2007 and 2008, the bomb went off. The impossible happened. Housing prices across the entire country started to fall. As values dropped, millions of homeowners with subprime, adjustable-rate mortgages saw their payments skyrocket, while their homes became worth less than they owed. Foreclosures surged. The assumption of uncorrelated risk, the very bedrock of the CDO market, was obliterated. Defaults happened everywhere, all at once, and it leaves us with the deeply unsettling question we still grapple with today. In a system that rewards such reckless behavior, has anything really changed? The Financial Crisis Inquiry Commission noted that of all the mortgage-backed securities Moody's had rated AAA in 2006, a stunning 83% had been downgraded to junk by 2010. These weren't investments anymore. They were toxic waste. The global financial system, woven together by trillions of dollars of these now worthless securities, froze solid. Banks had no idea who was still solvent. Credit dried up. In September 2008, the investment bank Lehman Brothers, choked by its exposure to this toxic debt, declared bankruptcy, triggering a full-blown global meltdown. The final report from the Financial Crisis Inquiry Commission was blunt, concluding the crisis was the result of widespread failures in financial regulation, dramatic breakdowns in corporate governance, and systemic breaches in accountability and ethics at all levels. In the end, taxpayers around the world bailed out the very banks that caused the crisis, socializing the losses while the profits had been privatized. Millions of people lost their homes, their jobs, and their life savings.